All right. Hi and welcome, everyone. My name is Maisie, and I'm on the marketing team at 3 Degrees. And I'd like to warmly welcome you to our first Climate Day. So, this is a day full of virtual events focused on empowering businesses to take meaningful climate action. The event covers European, APAC, and North American markets, and we're catering to a diverse global audience of sustainability leaders. So we kicked off the event earlier today with the state of APAC markets and a session on European renewable energy earlier this morning. And now we have a presentation on honing North American renewable energy. So we will be recording all the webinars for those who registered but couldn't attend. So don't worry if you couldn't make it to the earlier content. And I encourage you to sign up for any later sessions that you're interested to because we'll be running these all day. Now, just a few housekeeping rules. As mentioned, we will record the session and share it afterwards. And please use the Q&A chat box to ask your questions. We will have time at the end to get to all of the questions. And before we start, I'd like to briefly introduce 3 Degrees. So we make it possible for businesses and their customers to take urgent action on climate change. We do so through a suite of solutions tailored to each client, such as procuring high-quality environmental commodities worldwide, providing deep expertise and support with renewable energy procurement, and climate strategy support, such as setting goals to reach credible targets, among some other services. And 3 Degrees is a leading global climate solutions provider with over 20 years of experience across different markets. So this is a company overview. So it just shows how we are a global team with remote colleagues and offices all over the world. And today you'll be hearing from members of our Power Markets team who support clients worldwide in addressing their scopes 1, 2, and 3 emissions through both advisory, such as with renewable energy options assessments or RNG options assessments, and procurement like gas purchase agreements, physical and virtual PPAs, as well as PPA aggregations and supply chain solutions, among others. So now I will hand it off to Lauren Tatsuno on the Power Markets team and our other presenters to introduce themselves.
Hi, everyone. Thanks, Maisie. As Maisie said, my name is Lauren Tatsuno. I'm a senior director on the Power Markets team here at 3 Degrees. I've been at 3 Degrees for 5 years and have a background of more than 10 years in the renewable energy space, helping corporates procure to meet their goals. I'm joined by Amy and Adam, so I will pass it over to them to introduce themselves.
Hi, everyone. My name's Amy Chang. I'm an associate director here at 3 Degrees. I've been here for, I guess, 6.5 years now. Here at 3 Degrees on the Power Markets team, I support corporates in pursuing and reviewing their renewable energy options and implementing what they would like to, what works well for their organization to pursue. A large focus of what I do is PPAs in the US and APAC markets.
Hi, everybody. Adam Long, Senior Manager on the Power Markets team. I've been with 3 Degrees for just over 4 years now. And like Lauren and Amy, focus a lot on power purchase agreements, but also do a lot of work with green tariffs and other utility programs around the country, and focus a lot on the analytics and power market analytics that go into all of this. And excited to be here today.
Awesome. Well, here's what we are planning to cover in our session today, with the goal of providing some insights for those who are trying to hone their North American renewable energy procurement strategies. So first, we'll talk through what really are the options. We think that's a really great starting point to really see kind of the full suite of potential solutions that you could pursue when you're talking about addressing your renewable or your North American load. We will talk about impacts of the new administration. Obviously, that is playing a large role in how corporations are approaching their strategies this year and into the future. And then I'm going to pass it over to Adam, and he's going to cover sort of the state of energy markets and how that's impacting procurements in North America. We'll talk about some price trends when it comes to PPAs and specifically in the North American market, and then kind of wrap it up with what this means for you, how you can kind of take some of this and proceed with figuring out what might be the most beneficial options for you to pursue when it comes to renewable energy. So we can move into the options that we're going to talk about. So the first slide here, and we'll kind of sit here for a bit. So this is kind of how we view the landscape of options for renewable energy procurement in North America. The great thing about North America is that there tend to be many options. If you looked at this sort of landscape for other regions of the world, you may not see as many different bullet points here in terms of ways that you could address your load. But the good thing, the U.S. market, the Canadian market, they are both very mature renewable energy markets, and so you do have quite a few options on paper. One of the things once you start digging into all of these is there are really clear sort of trade-offs and pros and cons for all of these, and especially when it comes to things, and we'll talk about some of these criteria closer to the end of the session, but especially when it comes to things like cost and impact. There are very clear sort of, I wouldn't say winners and losers, but just big differences between these options. So we'll start by kind of talking through these, and just at a high level, we're not going to go in depth. Typically when we introduce clients to the concepts around a lot of these options, we have a full sort of hour and a half long education session that goes really in depth into all of these. So we're going to just touch it at the surface level, but I think it's a good way to sort of set the stage for our conversation in the coming slides. So one way that we tend to sort of break up these options is in, you can see the right and the left on this slide, contracts where you're really getting the RECs themselves. And right, the RECs are important because that's what allows you to make your renewable energy claim. So at the end of the day, you're trying to procure the RECs so that you can retire them in a given year and make those renewable energy claims. So one way is to just procure those RECs on their own. And then another way is to sort of get those RECs and your physical delivery of electricity together kind of on the same bill, right? So just starting on the left here, certificates, this is something that I think most people are familiar with. They're just unbundled. There's a market for unbundled RECs, a spot market where the price is constantly changing. It's, a voluntary market, and you can go out and just purchase the volume of certificates that you would like for at any given time, right? And to address your load in any given year. So that's sort of the simplest way to meet your renewable energy goals, and it's a very simple way to start, and it's how many companies start, is by simply purchasing RECs for a given year of their load. Also in this box are direct contracts, and I would say this is kind of on the other end of the spectrum, right? These are much more complex contracts. I would say there are things that maybe more experienced buyers tend to pursue, right? These are things like virtual power purchase agreements and REC-only power purchase agreements, where you are essentially signing a direct contract with a developer, and they are, in most cases, bringing a brand new renewable energy project online. So they're helping to add new renewables to the grid. It's a great sort of impact story, which is why many corporates pursue these options. It meets that sort of additionality criteria, right, where you're really being able to impact the grid with new renewables. And so a lot of corporate clients who are trying to diversify or maybe even move away from just buying RECs on the open market do tend to move towards some of these options because they can really prove their impact with helping to bring new renewables online. Obviously, virtual PPAs are very I would say, popular option for you've probably heard of many other corporates doing these, or maybe have done them yourself. And so we will talk through that in more detail in terms of just kind of the state of the market. So it is a great option. It tends to be cost effective, I would say, compared to many other options here. But it's not right for everyone, and I think that's one thing that we would always stress when we work with clients, is that it really is important to figure out which of these options really make the most sense for your organization specifically. Something that makes sense for one organization based on their preferences, may not make the most sense for another organization. So while we do a lot of virtual PPAs, it's something that we always ensure that our clients are really well versed in before they kind of enter into that sort of transaction. So moving over to the right side, this is where you can procure RECs and your physical delivery of electricity together. And so the two major buckets here are supplier options. So this is further broken down into electricity and RECs that you can get from your utility directly. And so that's in regulated markets where you are only working with your one utility to see what kind of renewable options that they have there. And then the other main bucket under supplier options is competitive retail supply. So that would be if you're in a deregulated market and you have options for working with different retailers there and trying to see what kind of renewable energy options that they might have in relation to one another. And then the other main bucket is on-site solar. So that's pretty straightforward. I think that is everyone's familiar with, that's mainly putting solar panels on your building, in your parking lot. Maybe you have ground mount area near your facilities. On-site's a great option. The main drawback with on-site is really that you tend to not be able to address a large portion of your load, just because roof space, or even when you look at carport space in your parking lot, right? You're not going to be able to put enough panels there to really cover more than maybe 5 to 10% of your load for a given building. So it's a great option. It's very impactful. It's very visible. You're directly reducing your usage of energy from the grid, but it tends to be sort of a piece of the puzzle, and not, I would say, the biggest piece by any means. It's a small piece of the puzzle, but something that is always great if you can make it work on a site-by-site basis. Going back to supplier options, there's a really big variety here, and I would say this is, of all the 4 buckets, this is the area where it is so dependent on where your load is, and it really requires going a little bit deeper and doing the research to figure out, really what is available to you, not only in your particular utility, right, but your options in your utility or with your competitive retailer are going to depend based on your specific load in that region, and other factors, right? Some options may not be available to every buyer in a utility, even though they might be in the same utility. Some options, such as physical sleeve PPAs, might only be available to really the largest users in a particular utility service territory. And, in other utilities, they may not have any options. And so it really is important, if you do look at these, if you do want to look more granularly at these, it really is the case of going sort of location by location to do that research and to understand what your options are. And there are various pros and cons with each of these, and the programs do vary quite significantly from utility to utility, or even from supplier to supplier. So it's hard to generalize, but these are, some of them can be attractive. It does require sort of doing that in-depth research. And then there's a wide variety of both sort of cost and also impact, right? Some of these programs are essentially just matching certificates with your electricity load. So, you could also just go buy certificates directly from an advisor or a broker. And some of these programs are, much more involved. They're much more similar to the direct contracts that you would sign with a developer. And so, again, it's a really wide spectrum, and it's going to vary quite significantly from location to location. And then the last box here at the bottom, this is kind of, we consider this kind of separately, but it is related, right? So investment of your capital into renewables projects. The call out here is really that they don't inherently include RECs, and so you really cannot make those renewable energy usage claims. You can say other things like, you're investing in renewables projects, but it really doesn't allow you to make those claims for your greenhouse gas accounting, for example. And these are things like tax equity investment or transferable tax credits. There are clear financial benefits to doing these types of transactions, but it really is sort of a collaboration, I would say, between your finance team and your sustainability renewables procurements teams as to whether these make sense for a particular company to pursue. There are clear impact benefits, right? You are really investing in the renewable energy transition to help bring new projects online by making either of these investments or purchase of tax credits. But again, it is different from really acquiring RECs.
So before,
Anything? Yeah.
yeah, yeah, before we move on to the next slide, I see two questions on our side on the chat or in our Q&A. We'll answer one of them, but for most of the other questions, we'll hold off to the end to answer. So the one question we'll address now is the difference between the VPPA and the REC-only PPA. So in the US, these are direct contracts that the buyer, the corporate, is entering into with the developer. Also here in the US, these are generally contracts for new projects that are not yet built. So in the VPPA structure, what the corporate is entering into is a contract for difference scheme. So you are entering into a contract, you're guaranteeing a fixed price to the developer, and what you're receiving in return is the floating price of the energy cost or the energy value that is liquidated when the energy is sold into the market. So in the VPPA contract, the corporate is taking that wholesale power market risk and guaranteeing the fixed price for the developer. And through that mechanism, a new renewable energy project is able to be built and brought online. These VPPA structures can only be completed in the US markets that have liquid wholesale power markets. The REC-only PPA is also going to support in the building and development of a new renewable energy project. But in this case, the corporate buyer is not going to take any of that wholesale power market risk. So the buyer, the corporate, is always going to just be paying a long-term REC price for that developer to guarantee that revenue for the RECs. In the VPPA, there are instances where you could be making money depending on what the energy market price is, other instances where you have to be paying out in order to make the developer whole. So just wanted to clarify those two options.
Yeah, thanks, Amy. They are kind of different. They are kind of opposite sides of the same coin, where really, as Amy said, right, the difference is that in a virtual PPA, you as the buyer are taking on that wholesale market risk. So there is really that volatility and uncertainty of the financial settlements into the future versus a REC-only PPA. You really are paying a premium to get a fixed price. And so the developer is keeping that wholesale power market risk, but you are getting a fixed price. So you know exactly what your costs will be. Not exactly, because it is dependent on the exact amount of electricity and RECs that the project generates, but you know your price per REC and per megawatt hour into the future. But it will be a higher price than simply going out and buying certificates, because again, you are helping a new project to come online. It does come with that impact story, but you will pay a premium for it. So these tend to be really great options for companies that are quite risk averse, because again, the premium is quite a bit higher. And so when you compare that to the virtual PPA, where there is the possibility of, there's always the possibility of potentially making some money there. It's more, we would kind of couch it as more being cost neutral would be the ideal scenario, but the rec only PPA, there's not that possibility. Okay, let's move to the next section here. Now that we've sort of set the stage, which is the impact of the new administration. And I know this is quite top of mind, I'm sure, for many people. And, a big part of approaching your North American strategy is, figuring out kind of when to do what, right? And that is something that we're not just which options to pursue, but in what sort of order and how to kind of put those all together in pursuit of your goals that have a time frame to meet those. So let's talk through kind of broadly potential impacts. Well, both current and potential impacts of the new administration. And so really, I think the headline here is that we're just seeing more uncertainty in the market, right? There's been a lot of things happening in the past month and a half that have led to some uncertainty in a variety of areas, right? And all of these play together differently to impact renewables in different ways. And so there isn't necessarily a clear story of how all of this is going to play out. I think that is kind of the overarching theme, is that similar to the stock market, it's really hard to time renewables and say, this is the best time to procure, this is going to be the best price in the next year. It's very difficult to do that. But we can kind of look at some of the trends and how things are playing together to see how renewables might be impacted. And so really we've kind of broken, in our view, we kind of view this in two buckets, right? So when we think about renewables, right, you're looking at the cost of electricity just in general, right? So for things like PPAs or, you're kind of comparing the cost of doing a renewable project with simply just purchasing electricity. And you're also looking at the cost of electricity from a perspective of, how is that going to impact the value of my VPPA? So we'll talk through that. And then also just the cost of renewables in terms of what's the cost of building new renewables, right? That's going to impact, obviously, the downstream costs to customers, whether it's in the form of a PPA or, RECs, for instance. So just starting with the cost of electricity, right, we see two main areas in which the administration is currently sort of impacting the cost of electricity. The first one is in demand. So some of this has to do with the new administration, but some of it is also just in general, we're seeing huge ramp up in demand from data centers with AI. With the new administration, there's obviously, we think there's going to be more crypto, and the forecasts really bear this out as well. And then obviously there's been a push to have more oil and gas production, and then as well as liquefied natural gas exports, right? So these things will, it's energy intensive to drill and to build the facilities that you need to export LNG. And so we do expect that as demand increases for electricity, that drives the cost of electricity up. And so, one of the other things we're kind of watching is also just general economic growth, whether that's there or not. And with economic growth typically comes an increase in electricity demand. Obviously, we'll see kind of how that plays out and whether that bears out. But in general, we are seeing an increase in demand in the US, which is projected to drive up the cost of electricity. And this is after, and Adam will get into this, is after kind of we've had lower prices for electricity in the past year or so. The other piece of this is natural gas prices. So electricity prices in the US are very tied to natural gas prices because natural gas represents sort of a bulk of our electricity generation fleet in the country. And so as natural gas prices change, that also impacts, electricity tends to move in the same direction as natural gas prices. So here we see that we anticipate there's going to be reduced regulation for production of natural gas. And then also, again, this build out of liquefied natural gas terminals for export to other countries. So with that, we see that as there's increased demand from the LNG specifically, and those tend to, LNG specifically tends to trade at a premium to sort of regular natural gas. And so that is projected to drive up prices somewhat. And so again, as gas prices increase, that tends to lead to an increase in the cost of the prices of electricity. So summarizing kind of the left side here, we do anticipate that electricity prices will go up. And a lot of that a lot of that depends on just, again, how much demand increases, how much natural gas prices increase. But that's kind of what we see on the cost of electricity side. Moving over to the right here on the cost of renewables, I think this is, well, some of these are, the capital cost piece, I think has become pretty clear in the past month or so, in the sense that this is where we're seeing a lot of uncertainty, right? Because of tariffs and changes there, right? We are seeing uncertainty in developers being able to set their costs to build new renewables projects. And so that is leading to some uncertainty in the PPA markets, right? As developers are maybe less certain of their costs from a build perspective, that gets kind of passed on in terms of uncertainty to buyers, and buyers needing to kind of take into account that uncertainty. So, tariffs are obviously increasing costs. Interest rates are not, have not really gone down. And so that is also increasing the cost to build new projects. On the incentive piece, this is a big question mark in terms of the Inflation Reduction Act and how this will potentially change in the near future. The ITC, PTC, so the investment tax credit, the production tax credit, these are sort of one of the major incentives for new renewable projects to get built. They've been in place for many, many years. And, I think we don't anticipate really that these will be impacted. I think there is generally broad support for these incentives specifically, but we really don't know. And so this is something where if there were to be major changes to the ITC, PTC, we would expect that the cost of renewables to really go up in terms of new build, and probably the pace of renewables additions would decrease if those were to really be significantly impacted. The other piece here is what I did mention on the previous slide, which is the transferable tax credit market. So this is something that has really gotten off the ground in the past couple of years, and it's become quite popular. It's a way for corporates with tax appetite to invest in new renewable projects. Sort of a simpler way than going the tax equity route. And so we are seeing a lot of activity here, but obviously if any of the rules around this were to change, then that market might be impacted. And it's something not only that corporates are taking advantage of, but developers, right? Developers have become comfortable with financing their project through the use of transferable tax credits as well. And then on the permitting and regulation side, we have seen changes here. On one hand, reducing regulations, we've mentioned that in the natural gas piece here, but we've seen more regulations and changing regulations. And when it comes to renewables at both the federal and the state and local levels, and really kind of what we're saying is just that at the state and local level, as sort of the federal rules have changed, some states that maybe are less favorable to renewables are also starting to implement some regulations that could negatively impact the siting and permitting of new projects, which of course would drive up the cost to build or really impact the availability of projects in certain regions. So, overall, right, these two things kind of play together, especially when it comes to PPAs, VPPAs, to really impact the value of those types of transactions for a buyer. overall, we kind of see them moving similarly, both sort of moving up, which at the end of the day, kind of not, they don't cancel each other out, but as both move up, it does sort of make VPPAs, the value of VPPAs, stay similar to what it was in the past. But again, there's just this kind of added uncertainty because we don't necessarily know what the ultimate effects of some of these things like tariffs will be on project costs. Adam, Amy, anything to add here?
Yeah, just one thing to add on the cost of renewables piece. I think the capital costs, the biggest thing here is uncertainty, as Lauren said, with the tariffs, of is this going to impact us? Is this not going to impact us? Are interest rates going to go down? And so that's really a piece of uncertainty. On the permitting and regulations, we have seen impacts already. We've seen permitting pauses on federal land that have actually caused projects to stop development and stop getting permits. And so we've actually seen impacts there. And although a lot of those have come off and projects are starting to get built again, timelines have slipped because of things like that.
And of course, as timelines slip, that can also impact costs. So there, all of these things kind of play together. And it really is kind of on a project specific basis, how they ultimately end up impacting the buyer. Okay, great. I will pass it off to Adam to walk us through the next section.
Yeah, thanks, Lauren. So as Lauren kind of laid the groundwork of the options and then all that's going on with the uncertainty right now, I want to talk specifically about what we've seen in the markets, both natural gas and electricity, to kind of look at some of these options, how these prices might impact those. And so the first one we'll look at is natural gas here. And the big takeaway here is that natural gas prices have rebounded or are on the rebound from historic lows. As Lauren mentioned, natural gas prices are driven by a lot of things, including liquefied natural gas exports. But 2024, we saw really a historically low natural gas prices. And as you can see on the chart here, really only 2 months, being January and December in 2024, that were above $3 per MMBTU, and several months below that $2 mark. And we haven't seen levels like that since deep COVID months, mid 2020, with really natural gas prices being at those historic lows. And this was caused by a unseasonably warm winter in late 2023, early 2024. That winter was pretty mild, and so natural gas storage levels got really high. And then we had record production of natural gas in 2024. And so record production paired with really high storage really meant that prices just never didn't get very high. In 2025, we have seen some, at least one liquefied natural gas terminal come online, sent it for its first shipment out in December of 2024. And so now that this liquefied natural gas is creating more demand, we're seeing that the supply that we're having, both storage and record supply, is being balanced out by increased demand, and we're starting to see these prices come up along with a cold winter that we had, which drove some of those storage levels down. So we do expect for natural gas prices to continue to rebound as more liquefied natural gas terminals come online. But not back to those 2022 levels likely, but rebounding from these historic lows. And as Lauren said, this has a huge impact on electricity prices. So if we go to the next slide, we'll see electricity prices, and this is really what matters for your renewable energy projects and for your strategy. And so we have the wholesale markets listed here over the past several years, and this is just an average monthly price here on dollars per megawatt hour. And you can see a couple things. So let's start with 2024. And all of the markets are pretty tight together and really between $20 and $40. And so really following those historic natural gas lows, electricity prices were pretty stable and were pretty low. And if you can, look at one line in particular being ERCOT here, that orange line, we're used to seeing a peak in the summer. So starting in 2019, you see this big summer peak And then in 2021, obviously the winter storm Uri peak. But in 2022 and 2023, we had a big summer peak. We didn't see that in 2024. Really, prices stayed really stable for the whole year. And like I said, it was due to mostly those natural gas prices, and also load did not necessarily grow as expected. And so for projects that do have, or for clients that do have PPAs that are operating in 2024, settlements were low. And that's part of that uncertainty of when you sign up for a VPPA. There are going to be years of high prices here that you can see. Had you had a VPPA operating in 2021, your settlement in February of 2021 would have been extremely high. Had you had a PPA operating in 2024, your settlements would have been pretty low. And so there is this volatility, which is shown here, that the electricity price is going to directly impact, and it does vary wildly from year to year. So moving on from this, I want to talk specifically about renewable energy trends. Now that we've kind of have the backdrop of what's going on in the electricity and natural gas markets, and talk specifically about renewable energy. The first option that Lauren mentioned was just the unbundled RECs. So we want to talk about those prices here. And this is the last 5 years or so of Green E wind REC prices, which tend to be the lowest priced instrument on a national level. So here's 5 years of historic pricing. And you can see some volatility here as well. So this isn't a risk-free market. There is certainly volatility in this price, which we're seeing in 2021, big price spike as there was a large orders being placed for RECs. But over the past 3 years or so, we've seen relatively stable REC prices between $2 and $3, with some volatility coming in as there have been large orders or large dumps from utilities that have excess RECs. And we see some of that movement, but overall kind of between $2 and $3. And we expect this to remain relatively stable, maybe a slight increase here. But this is for the unbundled prices. Lauren also mentioned the long-term, or the REC-only PPAs. And if you wanted to sign a REC-only PPA, she mentioned that there's a premium that comes with that. You're likely between $6 and $10 per REC. So you are paying more than we've typically seen in the unbundled market. But there are these spikes that could drive it higher, but you get that impact, that project specific REC. You can also buy RECs on forwards. You can buy 2026 RECs. You could buy 2027 RECs today, and those are going to be trading a little bit higher than this as well, and maybe that $3 to $5 range, depending on your volume and your vintage that you're looking for. But as I said, not a risk-free market, but it does provide some liquidity to just go out and make your purchase for a known cost at that point in time. Then the next pricing point we'll talk about is PPA prices. So Lauren went through kind of the cost to build and the capital costs that we've seen, and we really have seen PPA prices continue to rise in most markets, really for the past 3 or so years. And so starting on the left, we have the indicative solar PPA prices. And you can see, with the exception of ERCOT, which is in red, all markets have really gone up quarter to quarter. And this is the level 10 price index here that we use. We're just collecting a bunch of project data. But it goes up from really quarter to quarter in all markets. ERCOT has been stable over the past several years. We will see, this is the Q4 index, so we'll see what happens in Q1 as we've had tariffs and other uncertainty, and if prices are rising here. But the cost to build solar has increased with tariffs, with the cost of interconnection, with the inflation and cost of labor, interest rates. All of this has made it more expensive to build projects, and that's shown up in these PPA prices. Moving to the right, the wind prices, we really have seen increases in all markets. Even ERCOT is increasing here, and the wind projects are just really hard to build right now with the cost of steel. Tariffs are having an impact on wind as well, even though there aren't specific tariffs like there are with solar modules. They're having a big impact. Inflation, interest rates, interconnection, all hitting wind really hard and making it more and more expensive to build. So prices are, continue to rise. As Lauren said, timing the renewables market is extremely difficult. Of do we wait to go get a PPA? Do we do it now before prices rise more? And really, there are so many different factors that go into that. Like I said, in ERCOT for solar, which is what we see as the most popular PPA market right now, we have seen a fairly stable price, but other markets we do continue to see that rise. And so if we move on to the next graph, this really translates what we're seeing in PPA prices into what we're seeing for projected value. So as Amy and Lauren mentioned on how PPAs or virtual power purchase agreements we do the projected value, is we're comparing the PPA price or that fixed price that you're paying the developer to the projected floating market price. And so this does, these are all projections that we use many scenarios for, but our current mid-case projection for these markets, it can be shown here. And what we show as an implied REC value, which is the net present value of that contract or projected net present value per megawatt hour, so that we can compare everything. And starting on the far left, we have unbundled RECs, which unbundled RECs here being your option of just go purchase unbundled RECs. That line goes all the way across to show really what markets and technologies would be projected to be more cost effective. And as we talked about, this is really ERCOT right now. ERCOT wind and solar are both projected in the mid case to be more attractive than buying unbundled RECs, with ERCOT solar projected right now to have a positive settlement due to all the load growth that Lauren was talking about. But really the other markets, SPP, MISO, CAISO, and PJM, have gotten expensive enough to build in that the PPA prices are causing these economics to be projected to be worse than RECs. And so with that background, I want to bring us back to the options and bring us back to what this means for you and how to hone a strategy around this. And so when we talk to clients about this, we help clients come up with the criteria that matter to you. And these are some that we typically start with. We find that these work well for most clients, but we understand that there will be different criteria for each for everybody. And so your organization may have different criteria here, but let's just talk through these as I find that they work work well for most people. And starting on the left, the impact. This is really, is your renewable energy strategy going to drive major impact? Is it bringing new projects online? Is it helping to decarbonize the grid? Can you point to specific projects that you're working with? And does this matter to your organization? Is this what you want to focus on? And if you do, this is going to steer you, if this is a big priority, it's going to steer you towards those virtual power purchase agreements, maybe some green tariffs that are bringing new renewables online, maybe investments. It's going to point you there and point you away from unbundled REC purchases if pointing to a high impact is your number one piece there. Another one, of course, is cost. This one's a little easier to define on what is your projected cost. And also what is your projected cost known or unknown? As we talked about, a virtual power purchase agreement has a lot more risk, a lot more volatility, but it has a potential for a positive net present value. Whereas a REC only PPA, you pretty much know your cost, but it is definitely going to be a cost. And so weighing what this means for your organization and what are you willing to pay to get this done, and that will really start to point you in these directions as well. And then you'll pair it with risk, because obviously the lower cost options typically have higher risks, being the virtual power purchase agreement. Some green tariffs also use a floating market price to set something, and so you may have upside potential, but you may be taking on some of that wholesale power market risk. But there are other risks to consider here too. It's reputational risk. So with impact, if you want to be seen as a leader and you want to have that reputation as a leader here, pursuing higher impact options is going to be important for you to keep that reputation as a leader. And there are risks other than those financial pieces. And then timing, scalability, and complexity. I'll take these kind of all together on with timing, when are your goals and can you meet your goals using those strategies? If you have a 2025 goal and you don't have all the renewable energy online that you need, a VPPA is not going to work. You are not going to get a VPPA online by 2025. Unbundled RECs are going to work there. But if you have a 2030 goal, that gives you a lot more options for bringing a project online. And then Lauren hit on the scalability piece of on-site solar may be a great option for you, but is it going to get you to your goal? Community solar in some states has a pretty attractive payback for community solar, but sometimes you don't get the RECs, and oftentimes these projects are very small, and you're going to have a hard time meeting them, which leads us into the complexity of how much work can you tolerate on the back end, and can you manage 5 different green tariffs, community solar, and on-site solar? Or do you want to just have one VPPA that covers your whole load and have a one and done strategy? Green tariffs can also be less complex because they show up on your bill, whereas VPPAs can require more management. And so it really is taking all of these pieces together to say, what impact do we want to have? How much are we willing to spend? How much risk are we willing to take? What are our resources internally to manage this? When are our goals? And when you put this all together, it starts to point you in those directions of those options that Lauren laid out earlier. And this is also something that we help clients with, as Lauren said, with options assessments all the time, to look at all of this with you and really point to where that strategy is pointing you. So with that, I'll hand it back to Maisie to talk about our upcoming market report.
Actually, let's jump back
Oh.
really quick to I just wanted to add, so, this is also something, it's good to revisit this, and it's good to have a view of this when you're starting your journey with renewables, but also to know that it's probably going to change over time, right? So if you're just starting your journey, you might have impact in the back of your mind as something that eventually you want to get to more higher impact options. But it may be that, right now your main focus is going to be cost and risk, right? We see this often with clients where it really is a bit of a journey, right? And so, it's kind of weighing, what can you get approved now? What makes sense now? Maybe you do have a near-term goal, and so timing really needs to be sort of the biggest focus for any near-term procurement. You need to meet some percentage of your goal in the next couple of years, and so that's got to be the driving sort of criteria for anything right now. You know, Again, maybe you're just getting started, and so it's going to be difficult to get those like more complex options over the finish line, than it is to do something that's a bit simpler and then move into those complex options as sort of your organization gets more comfortable with just the concept of, starting to meet their renewables goals. Obviously, we always think that the higher impact options are great to pursue, but that's not to say that that is necessarily where you always want to start, right? We've also seen companies that have a lot of success with simply buying RECs to start, because that sort of starts to flex the muscle of purchasing renewables and gets the organization comfortable. And then by doing that, they're able to sort of make the case easier for some of these maybe options that have more risk, but they're more cost effective, right? If you say, hey, we have this cost on our books now, there's a way that we can actually reduce that cost, but it requires maybe taking on more risk. But hey, it's actually more impactful in the long run. So, all of these things really are trade-offs when it comes to all of the options that you can consider. And while all of these may be important, it is good to sort of have that really clear view for your organization of like, what is most important now? And maybe where do we want to go in the future? And what are the goals in terms of maybe flexing on some of these things as we move through our procurement of renewables. Okay, I think we can jump to the next slide, and I'll pass it back to Maisie.
Great. Thank you, Lauren, and thank you, Adam. I'll go quickly through this so that we can get to all of your questions. And if you haven't submitted it yet, please add any questions that you have to the chat, and our team will try to get through those in the next 10 minutes. But our Global Market Insights report is coming up. So this is going to be, we've released regional editions for North America and Europe in the past, and this is going to be our first edition of our global market report. So this is going to be released in the next few weeks before the end of March. It covers Europe, Asia Pacific, and North American markets. And I'm going to drop a link in the chat here where you can subscribe, and then you'll be among the first to receive it once it comes out. And now I will pass it to Amy for Q&A.
Yeah, it looks like we've got a few questions in the chat. So the first question, I think we've kind of spent a lot of time talking about the new administration and its impacts, but maybe if Lauren and Adam, you want to speak a little bit about the recent Canadian tariffs with respect to Canada and the impact on that we're kind of seeing or hearing on projects.
Yeah, I'm happy to take that. When we think about tariffs traditionally in the renewables area, we think about the anti-circumvention, anti-dumping tariffs that came out in 2021 against countries in Southeast Asia, which were really trying to prevent Chinese solar panels or solar modules from getting around tariffs that were already in place there. And so we think about module specific tariffs, and that's what a lot of the languages around. When we get into tariffs with Canada and Mexico, we start to look at other components that are going into renewable energy facilities. So it's not modules specifically. It is what we would call balance of plant pieces. So wiring and fencing and some, of the smaller pieces that actually do make up a significant portion of the cost. And so we do see a lot of these materials come from Mexico and Canada. And so that really is the cost uncertainty that this is driving, is if we do have these tariffs on balance of plant materials coming over the border, what is the impact going to be? And I think, as Lauren mentioned, it really is the on again, off again nature that is just making this really hard for developers to price projects because they don't know if they're going to have those tariffs when they actually go to buy those materials.
Okay.
Yeah, and I guess I would just add in terms of maybe just the unbundled, if the question was also on the potential impacts on the unbundled rec market. I think that's a little bit less clear. I mean, I would say most of the most cost-effective unbundled recs are coming from sort of US wind projects. And so I don't necessarily expect that some of the trade disputes with Canada would impact the unbundled rec market or pricing, because I think that's pretty separate and pretty clear that most of those unbundled recs are coming from the US anyway.
Yeah, on that piece, I'll add that when addressing renewable energy goals and targets, the US and Canada are viewed as a common market. So you can purchase unbundled RECs in the US market and attribute it to your Canada electricity consumption and to make your renewable energy claim. So if you are buying unbundled RECs in the US and using it towards your claims, I don't know. I think that's kind of viewed kind of as the same market like Lauren was describing. The next question here, I think going back to the different renewable energy options, if maybe you don't mind going back up to that slide. The question here is on purchasing renewable energy through a renewable supply contract in deregulated markets. So kind of in this navy blue box on the bottom under competitive retail supply. The question is whether REC purchases through those contracts would count as bundled, similar to green tariffs, or unbundled.
Yeah, I can take that one. So I would say sometimes the concept of bundled and unbundled recs gets used differently in different contexts. So I think it's important just to note that sometimes there can be different usages of those terms. But typically when we use those terms, right, when we talk about unbundled recs, we're talking about simply buying recs on the spot market, right? You're buying a rec, you're buying a commodity, it's not tied to a specific project. And so you can't sort of make that direct link to a specific project. And then when we talk about bundled recs, we are talking about recs where you know that it's coming from a specific project. And then in the case of like utility retail supply, it's coming from not only is your rec coming from a specific project, but your energy is sort of coming with that. So there are different ways to look at this because a lot of these retail supply options are quite different. So if you're talking about what's listed here, like a short-term retail supply product, oftentimes that's just the supplier purchasing unbundled recs from a broker essentially and matching them with your load and delivering them to you through your bill, right? So yes, it's coming packaged together with your electricity on your supplier bill, but we would sort of view that as an unbundled rec that's coming with your bill because they're simply going out and buying the cheapest recs on the market and matching it to your load. So we wouldn't view that as any more sort of impactful than just simply going out and buying those unbundled recs direct from a provider or a broker. That is, though, different when you talk about some of these longer term offerings or custom transactions, right? In those situations, the retail supplier is likely going out and signing contracts with developers to get renewable energy directly from specific projects. And in that case, they're potentially delivering you recs that are coming from projects that you can actually point to a name and say, by signing up for this long-term offering or by signing up from this custom transaction or a sleep PPA, right? There's a clear link there to you're getting recs from a specific project that is on your contract. And so it really depends on sort of which offering you're selecting, but they can range anywhere from, being sort of as similar to unbundled recs to being more similar to like a VPPA where you're contracting directly with the developer. So hopefully that answers the question. It is a little bit nuanced when it comes to some of those supplier and utility options because they can vary so widely. And I realize now we are at time.
Yes, I just wanted to thank you all for joining. And I know there are still a few questions in the chat that we didn't get to, so we can reach out with the responses to those. And if you have any additional questions, our presenters' emails are on the screen right here, so please feel free to reach out. And I hope you all have a great rest of the day and have a few more Climate Day sessions lined up. Thanks again for joining.
Thanks, everyone.